people, how are ya? Hope you're doing great as always. Welcome back to the Financial Fortress. And let's take a look at this crazy market we are having, right? Because, of course, in the long run, as an investor that's, kind of trained and used to this volatility, this shouldn't mean really anything to you, right? Just, put on the blinders, buy a great assets, right? Great businesses that will appreciate over time in any economic environment, right? Whenever we are seeing inflation, whenever there are some fears about, potential downturns, energy prices, this all is, just a little bit noise around. But at the same time, it's great to a little bit train our minds and go through some of those scenarios that might happen and understand a certain, pulls and levers in the macroeconomic environment that might happen. And, so these days, lots of people are, spreading lots of fear, uncertainty, doubt, and this kind of stuff. So let's take a little look into if can we be in like the bear market. And if you came just for an answer, right, in my opinion, this is just a correction. I'm saying this, I'm calling this, and I will show you why I think so. And of course, it's not just my opinion. It's, I've basically come through this through a research of Edward Yardeni, one of the people that I really admire. They are producing a lot of great data concerning macroeconomics that I often look to, kind of the overall PE piece for different sectors. And let's take a look about their so-called Blue Angel analysis, right? And what this does is basically, if you look at the chart, let's maybe zoom in here on the S&P 500, right? This is S&P 500 and their PE ratios, right? In the red, that's the actual one. And in blue, you have a different tiers. How would the valuations look like if we were paying certain PE for the market overall, right? So, basically by 2 points from 10, 12, 14, and so on. So you can see how much were we basically paying for some of those companies. And as you can see, the PE for S&P 500 was kind of a steadily rising, right? If you, for example, look back to this period from 2014 to 2017, we were roughly paying a multiple of like a 16 to 18, right? But basically since the pandemic here in this like super short bear market, we've pretty much exploded, right? And either corrections or bear markets happen when we are seeing either or both of compression of a PE ratio, right? Price to earnings. And that's basically what investors are influencing, right? It's basically how much are we willing to pay for certain companies, for certain earnings they are having, right? So that's in a sense kind of a consensus of a market. So now we are basically saying that, okay, now we are fine with paying 20 PE. But maybe at a certain point we kind of realize, okay, maybe that's just too much. So maybe we just need to slow down a little bit and either have some correction or let the earnings to basically outgrow the PE. And we can see slightly similar trends for like the S&P 400 and S&P 600, right? But the thing is that here the valuations are not that out of whack, right? Basically we were actually paying more for some of those companies from S&P 600, right? For some of those small caps in like 2014, 15, 16, 17, we were paying almost 20 times the earnings in like 2017, and now we are paying only 14. That's a bargain. So, it's just one of the another basically implication that the small caps and even the mid caps are relatively undervalued at the moment. But then we are also having the main question, right? Is it a correction? Is it a bear market, right? And I've basically written one of the notes from Edward Yardeni, right? And what's basically based on the statistic, right? It seems like the bear market happens when both the price to earnings and the actual earnings are compressing, right? So in a relatively bad economic environment. And we can see that since since basically the bottom of the pandemic, the company's earnings been on a steep upward curve. So like basically saying the underlying economy is doing fine. It's just the PE that's compressing. It's not the earnings. For us to enter a bear market, we would need to have earnings declining as well. And as we've seen from even this earnings season, the underlying economy is doing relatively well. Of course there are hiccups. Of course, since we stopped the economy basically during the pandemic, and we did like this whole economic restart with logistic chain and everything, it's obviously hard to kickstart it again. But seems like we are on a good track. So the bottom line is this should be a correction, and maybe especially in those large caps, right? Because we are paying relatively a hefty multiple at the moment, and that might come down a little bit more. But again, that's something that you really need to understand happens, right, in the long term. If we are basically looking at this chart from 2007 to 2000 to basically now, we've seen different environments with a different basic appetite for the investors, right? When we were coming out of the 2008, 2009, we were, a little bit scared, right? Not paying that hefty multiples. And as the bull market continues, we were paying a little more and a little more. And, maybe it's a good time to a little bit, get a breather and, just wait for the earnings to catch up, and, maybe look for some of the opportunities in the small caps, mid caps. This seems to be very fairly priced. So, of course, it's up to you to make the decision for your portfolio, but these are my 2 cents. Hope that helped. And, if you like the video, subscribe, tell your mama, tell your neighbor, whatever you feel like, and see you soon.